In this video, we're going to perform some calculations to determine whether or not a couple should file jointly versus separately for a given tax situation. In this example, we'll assume we're told that John and Jane Doe are married and they don't have any dependents. John incurred some significant medical expenses during the year related to an unexpected surgery, and because of this, they want to know, does it make sense for them to file jointly or file separately for 2021? We're also given this information in this table for just their salary, interest, income, and other tax information. Now, to determine whether they should file separately or jointly, we basically need to run through a quick calculation to determine what are their income, what are their tax liabilities under each situation. Now, we're going to, instead of retyping all this data to do a bunch of stuff, I'm going to manipulate it around as we do the work. So we know that their incomes, John and Jane's income, and we also know what their interest is. Now, from that, we can calculate their gross income just by adding these together. And then we will do the okay. We also know that when they file jointly, their incomes are also going to add up, so we'll need to carry this information over. So that'll tell us their joint income. But we do need to adjust this interest income a little bit, because this needs to be distributed amongst these two. So we know that 400 is the 400 is going to become 1,500 because we're going to take this joint income that they have as interest together and distribute it between the two. So the 400 will become 1,500, and then the 1,200 will become 2,300. And then when you add these together, that will end up being $3,800 worth of interest income between the two of them. Now, from there, we'll need to deduct their deductions for AGI. Now, in the problem, we're told these, so we will drag this back up, and the totals for these will be for jointly. Now, from there, we will get their adjusted gross income, or AGI. Now, once we do that, we'll need to utilize this medical expense data, because that may be deductible, subject to 7.5% floor on expenses. So to do this, what we first need to do is we'll come over here to the side and then just say that their total medical expenses, and we'll do less the 7.5% floor, and then that'll give us the actual medical expense deduction. And we know that for the two, we will end up with John's medical expenses. Let's see. Yeah. Instead of drag the data over. Their joint medical expenses are going to be the sum of those. Now, to determine the floor, we need to actually use their adjusted gross income that we just calculated. So it's 0.75, or excuse me, 0.075%, or 75 times a percent, times their adjusted gross income. We're going to get rid of this and just, we'll round everything. We're not going to worry about to the dollar. And then from that we can calculate their medical deductions if they're eligible by subtracting the two. Now, since Jane has a negative one, you can't have a negative deduction, so it's 0. That simply means that her medical expenses did not exceed the 7.5% floor. Therefore, she would not get the deduction. So for John's medical expenses, 0, and then 3630. Now we need to deduct their state income tax and real estate taxes. State all right. Okay, so for their state income taxes for John, he's going to get $900 plus he gets a portion of this 52,800. So if we take that, so then he'll get 900 plus the 2,900, so that'll be 3,800. And then for Jane, she gets this, she'll add this to that as well, so it's 13. But because she'd be filing separately, she only gets half of that. She's capped at 5,000. And then married filing jointly, they'll be capped at 10,000. So those are their state tax deductions. So once that's done, now the mortgage interest, we can bring that up as well. If they were to do this separately, they would each get 2,100. Divide that by 2. So once we know that, we can do the basically the total of their itemized deductions or the standard deduction, whichever standard deduction for the married filing jointly. Sum these together. Right, now for the married filing jointly, we can see here that this is going to be larger, or the standard deduction would actually be larger in this instance. So in that instance, they'll get to 25,100 since that's a larger deduction. Right, so once we do that, then we can have the total deductions from AGI. We know this. We can now calculate their taxable income, which is just going to be the adjusted gross income minus the deductions. Whoops. Okay. Minus their deductions. And then from there we can calculate the tax. To calculate the tax, I've actually done that ahead of time. In the particular textbook this problem comes from, they want you to use the tax formulas as opposed to the tax tables. So I'm just going to go through with use what the actual tax was. All right, and then now we need to try to these expenses are not actually usable, so we're not worried about those. And then we need to calculate what is their savings from filing jointly. So their tax filing separately. Okay, so the tax from filing separately is going to be the sum, these two numbers, and then their tax from filing separately is here, and the savings is just the difference. So in short, if they file jointly, they'll save $2,700, or yeah, $2,774 in taxes. That's going to be it for today. Thanks for watching. I'm going to record a voiceover here because I glossed over some of this. The reason that Jane's state and local taxes were capped at $5,000 is because the $10,000 cap that everyone hears about in the news is split between partners when there's married filing jointly, or married filing separately, excuse me. And they get $10,000 in total when they married file separately, or married file jointly. Sorry, I get those backwards. And the reason that we do not care about a standard deduction when they are married filing separately is because whatever status one person uses, the other must use. So if John chooses to file to itemize deductions, then Jane must itemize as well. She's not allowed to take a standard deduction. If they were both going to take the standard deduction and file separately, it would not make sense to not file jointly because the two standard deductions would add up to the standard deduction for a married couple. Sorry if I glossed over that, but hopefully that clears things up. Right, and the $1,200 at the end, that was just ignored because there's no provision that allows for an unreimbursed employee expenses to be deducted. So that's just extraneous information to try to throw you off. All right, thanks. Have a good day.